Last two times we've been discussing why to have an organization and how to organize your business and not just use one structure. Last time we talked about the differences between C corporations and S corporations, what it requires to form them, and those types of obligations and procedures. We're going to do our third video today on limited liability companies. Limited liability companies are not corporations. A lot of people, when I talk to them, which I find interesting, call them limited liability corporations. They are not. In fact, as I would invite you to go to the IRS webpage and look up limited liability companies, and it explains to you what they are and what they are not. Now, in addition to that, just so you're aware, the IRS does not recognize limited liability companies as such for a tax purpose. The states recognize and control limited liability companies. Every state has its own regulations and responsibilities as far as a limited liability company. However, most limited liability companies that I've ever been associated with, and I don't know of any other, they actually do have similar laws in each state which protect the owners and the managers of the company. A limited liability company, however, is formed by contract. Some states call the document to form a limited liability company articles of organization. Others call it certificate of organization. So what we want to do today is just to discuss what has to be in those, the same as articles of incorporation for a corporation. Limited liability companies complete articles of organization or a certificate of organization, which gives the name, the purpose, the registered agent, the address. Those are the same things in everything, in every state. But the only difference is that the laws governing it are different. And actually the articles of organization or certificate of organization only informs the state that such is being recorded and filed. The state then has to recognize that as that type of an organization. Now it knows which laws it's governed under. But a limited liability company's main document is called an operating agreement. An operating agreement is like a partnership agreement. So when you go into partnership, you have a partnership agreement or contract signed. An operating agreement is exactly the same thing. All the members must sign an operating agreement. A limited liability company only operates by owners owning and managing the company. So a limited liability company can be managed by either an outside general manager hired by the owners, and the owners are called members. So they're a good organization if you're not a single member LLC. So the corporation has two different types of members. The first one is what's called a single member LLC, one owner. And anybody can own a limited liability company, anybody or any entity. Trusts are one of the things we're going to be talking about later. We encourage all owners to have a trust to own their limited liability company in conjunction with others. In no case do you want to be considered a single member LLC. The IRS considers a single member LLC a disregarded entity. The reason for that is that a limited liability company has to be taxed in a certain way. That's why the IRS doesn't recognize limited liability companies as such for tax purposes. A limited liability company can elect to be taxed as a corporation or a partnership or a sole proprietor, which is one owner. Now, let me just talk a little bit about business organization and safety. In every case, whether it's a corporation or a limited liability company, the company must be separated from the owners. Shareholders in a corporation, members are the owners of a limited liability company. And they must be separated from the business and act independent. The business itself must treat the owners no different than they treat anybody else on the outside. Cannot have any special considerations. Can't be given free cars to drive without having some sort of a reason for doing it, and in many cases, having to charge the individual as part of the income of that individual. But a limited liability company does offer some benefits tax-wise that we're not going to go into this here as compared to a corporation or an S corporation. So the limited liability company must have, first off, a certificate or articles of organization that are filed with the state. It then must have an operating agreement, even if you're a single member LLC. And third, it must keep minutes. It must have meetings. That's why the IRS considers a single member LLC a disregarded entity. How is one individual going to have meetings with themselves and keep minutes of those meetings and separate themselves from the business? What's going to happen is that, especially if they have a good attorney, somebody's going to sue that LLC and say, you can't separate yourself from the business, therefore, you're not an LLC. You may call yourself an LLC, but you're not. You can't separate yourself. So they can pierce the corporate veil and come after the owners, and the owners can become personally responsible for all the debts of the LLC. If you're organized properly so that you can separate yourself and not have to do that, then the limited liability company protects the members, the owners, and the managers from any personal responsibility for limited liability company obligations. So the one thing you don't want to be is a single member LLC. The second level is a multi-member LLC, which means you have to have at least two owners. Now, in that case, in either case, you can elect to be taxed as an S corporation. And one of these days, we might get into S corporations because for every advantage of an S corporation, there are 5 disadvantages. So we recommend that in no case do you ever have your limited liability company taxed as an S corporation. A limited liability company, therefore, if it has more than one owner, is taxed as a partnership and elects to be taxed as a partnership when it files for an EIN with the IRS. If you are a single member LLC, you're taxed like a sole proprietor. You don't have a special tax form. You don't have anything separate. The LLC doesn't prepare its own tax form. You put everything that happens to do with that LLC on your personal income tax as though you were not an LLC. You just use that name. Therefore, you really have no protection. Now, the general manager can be outside, but inside, the IRS requires that all the members elect one person to be the tax matters partner. That one member must have authority from all the rest of the members to be able to act in behalf of the LLC and defend the LLC or appear for the LLC in any IRS required hearings and be able to sign for that LLC. Therefore, one of the partners is a tax matters partner and signs all the returns, signs all the documents except legal documents. The managing member, and it can be the same people, the managing member and the tax matters partner can be exactly the same person, but the managing member is the one that signs all agreements for and in behalf of the LLC. When you file for a bank statement with an LLC, you need to take into them your recorded articles of organization or certificate of organization as recorded and stamped and approved by the state. And you also take in the EIN letter from the IRS that gives the LLC its own tax ID number. You also take into it the operating agreement. But the one part of those documents that are really most important is the minutes. You have to have minutes. When you first start an LLC, you have the organizational meeting of the members. They elect the managers and they accept whatever investment is made by the company. And not by the company, by the members. Sorry about that. And in the minutes, they also talk about the banking and set up a banking resolution. Most of the banks require all members to sign, but it's not necessary. So therefore, you take the minutes in, and in the minutes, you make sure that there is only one person required to sign on the checks, and that person's either the general manager or whoever you want to have, and you put that in there. But in the minutes itself, whoever is authorized to sign is designated in the minutes. That's the most important thing that you take to the bank. Operating agreements should never have managers in there. They don't say who the managers are. They don't give what the manager's specific responsibilities are, even though they give a generic idea of what the managers would do. The other thing with an LLC that you need to understand is that there are two types of ownerships in the company. Two sides, they call it interests. The first interest is contracted. In the operating agreement or some other certificate, the members agree that this member gets 50% or 40%, whatever the percentages are divided by contract. Therefore, they're a contractual ownership. There's no money required. There's no investment required. There's no equity required. But the other interest is an equity one. It has to do with the investment made by the individual members. Therefore, if you have a limited liability company that makes a profit, that profit is distributed based on the ownership, contracted ownership of each member, and that profit is passed on to the individual members. Then the individual members pay tax. The LLC does not pay its own tax like a corporation does. The members pay the tax based on their percentage of the profits that they realize. Then the LLC may have a loss. If the LLC has a loss based on the same percentages, it passes the loss to the members. However, the members cannot deduct the loss against their personal income unless the members have an investment, an equity position. The IRS calls it a tax basis. Unless the members have that equity position in the company, they cannot deduct any losses for that LLC, whether there's losses or not. They don't get to take advantage of those losses. So you want to make sure that each member has both a contracted interest and an equity, a tax interest in the LLC, that there's some sort of investment. Because if there's a loss, you can reduce your taxes based on the loss of your equity in that company. Now, one other thing that you need to be aware of. LLCs are only required to meet once a year and keep minutes. But if you don't keep minutes on a regular basis and you don't have meetings on a regular basis, now you're acting again as an alter ego. You just call yourself an LLC, but you don't act like one. Therefore, the corporate veil can be pierced. And the LLC can own assets, and that's the biggest benefit for the members, because the assets now can be depreciated because they're now business assets. And those business assets can be depreciated based on standards set by the IRS, and that depreciation is a non-cash depreciation, which means that without spending cash, you can get deductions against the income of that LLC. In addition to that, the members are not required to pay themselves a salary. And unless you make a lot of money, you don't have to pay quarterly taxes. You just pay your tax at the end of the year. You can do so either as a draw, or you can pay yourself as a 1099. And there's a whole bunch of other tax benefits of a limited liability company. Remember, in every case as a limited liability company, that you want to have an investment, you want to designate who the tax member's partner is, and you want to be able to act like a business. That's why the partnership, because now you can have meetings and there's more than one person to have a meeting with. If there are any other questions, we can refer to those questions on the next video.